The problem: why traditional LTCI fails seniors. Here's the hard truth. Traditional long-term care insurance was built on assumptions that didn't hold. People lived longer, care costs rose faster than expected, and insurers mispriced risk. The result? Rising premiums, shrinking benefits, and stricter claims reviews exactly when your health becomes fragile and your budget fixed. Let's break the failure points. First, premiums. Insurers place many older LTCI policies into closed blocks. That means no new young buyers are joining to balance costs. As the pool ages, claims grow, and the only lever left is rate hikes. If your retirement income is mostly fixed, Social Security, a pension, conservative withdrawals, those hikes don't fit. You either pay more, reduce benefits, or lapse the policy. Any of those can blow a retirement plan. Second, eligibility at claim time isn't as straightforward as "I need help, pay me." Policies usually require you to need assistance with a certain number of activities of daily living. Things like bathing, dressing, toileting, transferring continence, and eating, or have a documented cognitive impairment. The thing most people miss is how tightly those triggers are defined. If your doctor notes don't match the policy's wording, or if the assessment understates your needs, your claim stalls. This clicked for me when I saw a client denied because they could technically transfer with minimal assistance, on paper, though real life looked very different. Third, elimination periods. Think of this as a deductible measured in time. Some policies count calendar days once you qualify, others only count service days you actually receive paid care. That difference can drag a 90-day waiting period into months of out-of-pocket spending if you don't schedule enough qualified visits. Now here's where most people mess up. They start with minimal hours to save money, not realizing it extends the elimination time, delaying benefits and increasing total costs. Fourth, inflation versus benefit caps. Many policies cap daily or monthly benefits, say $200 per day. Meanwhile, local home health can run far higher and memory care facilities more still. If your rider grows at 3% compounding while local costs climb 5–7% in your area during tight labor markets, the gap widens every year. You feel protected, but your purchasing power silently erodes. Let's do simple math. Suppose you started with a $3,000 monthly benefit, 3% compound. After 10 years, that's roughly $4,000. If local home care moved from $28 to $40 per hour in the same period, and you now need 6 hours a day for safe coverage, you're at about $7,200 a month. Your benefit covers barely half. The shortfall still hits your portfolio every month of care. Fifth, misaligned incentives. Insurers push rate increases through regulators to keep blocks solvent. Retirees on fixed budgets can't easily absorb them. The forced choices: pay more, reduce inflation protection, cut the daily max, or lapse. Set it and forget it doesn't work with LTC planning. You need periodic reviews, stress tests with realistic local costs, and written options from your carrier, or you'll find yourself negotiating under duress. Another friction point is definitions of covered settings. People assume home care means the helper I hire. Policies often require licensed caregivers or agency-provided care to count. If you hire privately to save money, those hours might not apply to your elimination period or reimbursement. Pre-authorization and plan of care requirements create another snag. If you don't have a physician-signed plan that mirrors your policy triggers and specifies services, you invite delays. Now Medicare. Many folks expect it to step in for long-term custodial support. It doesn't. Medicare is built for acute, skilled episodes, therapy after a hospitalization, short-term skilled nursing, not months of help with bathing, meal prep, or supervision for dementia. So when traditional LTCI underdelivers and Medicare can't cover custodial needs, the gap hits your savings. Here's the pattern most people miss with rate hikes. Early increases feel small, 5% then 8%, but they stack and the base grows. In year one, $2,400 becomes $2,520. A couple more increases and you're paying $3,300, then $3,800. Over a decade, cumulative hikes can double premiums while you're also absorbing higher living costs. Without a plan to adjust benefits deliberately, you can end up paying more for less. Common mistake: keeping a 5% or even 3% inflation rider no matter what because inflation is high, without testing if your budget can support projected premiums. The better move is to analyze your policy's increase history, request your carrier's alternative options in writing, reduced riders, shorter benefit periods, paid-up options, and model how each choice affects future affordability and claim power. Let me show you exactly how to avoid the early stumble. Before any claim, assemble a care readiness file. Your policy, the summary of benefits, the exact ADL trigger language, elimination period type, and qualified provider definitions. Pair that with a physician letter template that uses the same ADL wording as your policy. That alignment removes ambiguity when an assessor reviews your file. The reason this works is simple. LTCI is a contract game. When your documentation mirrors contract triggers and your care hours are structured to match elimination rules, you stop bleeding cash in the waiting period and shorten the path to benefits. If you remember nothing else from this section, remember this. Affordability erodes slowly, but claim denials happen fast when documentation is sloppy. Most people think rate hikes are random. Here's the pattern. Closed pools getting older and sicker drive planned increases. Therefore, you need proactive reviews, not reactive panic. And as you'll see next, even if you survive premium increases, there's a second trap baked into the fine print that delays or denies care right when you need it. Trap 1: the rate hike death spiral. Most people think rate hikes show up out of nowhere. They don't. They're the result of closed blocks. Your policy sits in a pool that's aging, getting sicker, and not getting new young buyers to dilute costs. Claims rise, investment yields fall, and the insurer asks regulators for increases. You get the letter and the game begins. Pay more, cut benefits, or lapse. That's the death spiral. Here's why small hikes hurt big. A 10% increase on $2,400 a year is $240. Not awful. But next year's 10% hits $2,640, then $2,904. Compounding on a rising base quietly doubles premiums over a decade. Meanwhile, groceries, property taxes, and care costs go up too. You're guarding the front door while the back door is wide open. Eventually, you're forced to choose: keep the policy and squeeze everything else, or fix it by reducing the inflation rider, shortening the benefit period, or raising the elimination period. Each fix weakens claim power. That's the trap. Now here's where most people mess up. They wait until the deadline week to react. Under stress, they check the cheapest option box without modeling the long-term hit. The better move is to treat every increase like a fork in the road you'll document. You want 3 things in writing from the carrier: the current premium and benefit schedule, every alternative option with exact premiums and benefits, and the projected premium trajectory if approved increases continue. You also want the last 5 years of your increase history. Once you see the pattern, you can make choices with eyes open, not hope. The thing most people miss is how the inflation rider drives both protection and price pressure. A 5% compound rider can be a lifesaver in a high-cost market, but it's often the single biggest lever driving each new increase. This clicked for me when a client cut their rider from 5% to 3% after 3 hikes. On paper, it looks small. In reality, the lifetime value of their benefits fell by 6 figures in today's dollars. They saved $600 a year and lost purchasing power they'd need in their late 80s. Don't do that blindly. Let me show you exactly how to analyze your situation. First, list your policy's key specs: current daily or monthly max, remaining benefit pool, inflation rider type and percentage, elimination period type, and any shared care features. Second, pull local care prices today: agency home care, hourly, assisted living, memory care, and private room nursing rates. Third, estimate a reasonable local inflation rate based on the last 5 years. Don't default to 3% if your market's been running closer to 5%. Now stress test. Project your policy benefit growth against those costs for 5, 10, and 15 years. Where's the gap? That gap is your future out-of-pocket. Once you nail that, everything else clicks. You're not reacting to a single letter, you're calibrating a plan. Ask your carrier for alternatives that maintain claim power where you actually need it. For example, instead of chopping the inflation rider, you might shorten the benefit period slightly while keeping a higher daily max to cover home care hours now common in your area. Or you keep the rider but switch to a longer elimination period and set aside a dedicated cash reserve to cover it. The game changer nobody talks about is pairing policy tweaks with a cash bucket so the policy can survive without starving your lifestyle. Before we continue, you need to understand closed block dynamics. As more policyholders lapse or reduce benefits, the remaining pool skews toward people who expect to claim. That raises expected costs further, which pressures premiums again. Therefore, relying on maybe the hikes will stop is wishful thinking. Plan for continued pressure and decide if you'll keep, modify, or exit on your terms, not theirs. Quick win you can do this week. Write to your carrier and request in writing all non-forfeiture and reduced benefit options, paid-up options if available, and a history of rate actions on your form series in your state. Then call 2 local agencies and get written hourly quotes. 15 minutes per call, done. With those numbers, plug into a simple spreadsheet: premium now, premium after options, benefit growth, and local cost projections. You'll see which option preserves the most care hours per dollar. Common mistakes to avoid: keeping a rich rider without budgeting for future hikes, reducing the daily max below your local hourly cost times realistic hours, extending the elimination period to 180 days without a dedicated reserve, assuming shared care will save you if your spouse won't meet underwriting later. Another big one: dropping coverage entirely in a bad year without pricing alternatives first, like a hybrid policy or a smaller paid-up benefit that still creates leverage. If you remember nothing else, remember this: don't let the insurer design your response. You design it. Use their options to build a version that keeps real-world buying power, not just a lower premium. Survive the rate pressure with a plan and you avoid trap 1. Even if you do, there's another trap baked into the fine print that can delay or deny care when you finally file a claim. Trap 2, the fine print that delays or denies care. This next part separates beginners from pros. Your policy's fine print. Most denials and delays aren't about whether you need help. They're about whether your paperwork matches your contract. Let's fix that. Start with triggers. Policies typically require you to need help with 2 or more activities of daily living or have a documented severe cognitive impairment. The thing most people miss is how the policy defines substantial assistance and standby assistance. If your doctor writes "need some help," that's vague. You want language like "requires hands-on physical assistance with bathing and transferring due to unsteady gait and frequent loss of balance." The reason this works is adjudicators compare notes to contract wording. Vague notes equal stalls. Now, cognitive impairment clauses. Many policies require standardized testing and a physician's diagnosis, not just memory issues. Ask your doctor to include test results and a clear statement. Severe cognitive impairment requiring substantial supervision for safety. Tie it to risks: wandering, medication mismanagement, inability to follow multi-step tasks. That specificity aligns with contract language. Elimination periods are where people quietly lose thousands. Some policies count calendar days once you qualify. Others count only days you receive covered services from qualified providers. If yours is service days, 3 days a week of care turns a 90-day elimination into 30 weeks. Here's the shortcut nobody teaches. During the elimination period, schedule at least 5 service days per week with a provider that meets your policy's definition. Yes, it costs more upfront, but it shortens the clock dramatically and pushes benefits sooner. Calendar versus service days also hides a second trap: who provides the care. Many contracts require licensed or agency caregivers to count toward elimination. Privately hired helpers, family, or unlicensed companions might not count. Before you hire, call the carrier and ask, what provider types satisfy elimination days and reimbursement? Get the answer in writing. If they say licensed agency, choose one and ask them to include license numbers on invoices. Facility versus home care definitions can clip benefits too. Some policies pay different amounts or require different documentation based on setting. For assisted living, they might need proof of state licensing and a care plan on file. For home care, they may require a plan of care signed by a physician and executed by a nurse or care manager. Don't assume your favorite residence or private aid qualifies. Validate licensing and care plan requirements first. Pre-authorization and plan of care pitfalls are common. Many carriers expect a physician-signed plan listing exact ADLs, frequency and duration of services, and safety supervision. Missing signatures, wrong dates, or vague task lists are classic stall points. Build a one-page template your doctor can sign. Diagnosis: ADLs impaired, expected duration e.g. 12 months, services prescribed: bathing, dressing, transfers, med management, supervision, and a line that says care is medically necessary to prevent injury. Keep copies. Now, documentation during claims. Keep caregiver timesheets with start and stop times, tasks performed, and signatures. Align tasks to ADLs and instrumental ADLs your policy recognizes. If it says bathing and transfers, make sure logs list those words. If a nurse does an initial assessment, request a copy and confirm the language mirrors your policy's trigger terms. If it doesn't, ask for an addendum noting specific ADL dependencies. Let me show you exactly how to avoid the calendar traps. Step 1. Call the carrier, confirm your elimination period type, qualifying providers, and whether care must be scheduled on consecutive days. Step 2. Book care to meet that standard, ideally 5 days per week to accelerate service day counts. Step 3. Start the physician plan of care process before the first visit so day 1 counts. Step 4. Keep every invoice, log, and note in a binder labeled by week. When in doubt, over-document. Common mistakes to avoid. Starting with 2 days a week of care to save money, which drags your elimination period, hiring unlicensed caregivers whose hours won't count, relying on a generic doctor note with no ADL detail, forgetting that cognitive claims need formal testing and a diagnosis, and sending incomplete packets, missing signatures and dates get kicked back. Quick win, create a 3-item checklist. 1. Exact ADL trigger wording from your policy copied into a doctor letter template. 2. Elimination period type circled with your target schedule, calendar, or 5 service days per week. 3. Provider qualification proof, agency license, NPI where relevant, and care plan on file. Hand this to your spouse or adult child so anyone can run the process. A micro story to drive it home. Last month, a viewer's mom had a 90-day service day elimination. They booked 3 days per week to keep costs down. At day 60, they'd banked only 20 service days. We flipped them to 5 days per week with an agency that met the contract, updated the doctor letter to mirror ADL triggers, and they cleared the elimination in 4 more weeks. The difference was not more need, it was better alignment. If you remember nothing else from this trap, remember this: benefits aren't just about need, they're about matching your paperwork and providers to the exact words in your policy. Do that, and you turn denials into approvals and months of delay into weeks. And the silent killer after approvals? It's inflation outrunning your caps coming up next. Trap 3: the inflation gap and benefit caps. Now let's talk about the quiet drain, inflation eating your benefits while caps box you in. The mistake that ruins budgets is assuming a 3% compound rider keeps you safe. It doesn't if local care costs are climbing faster, especially for home health and memory care where labor drives prices. Why this matters? Long-term care is labor-heavy and wages usually rise faster than general inflation. When your policy grows at 3% and your local costs grow at 5–7%, the gap widens every year. Early on, it's a few $100s a month. 10 years in, it can be thousands. That shortfall hits your savings every single month of care. Here's what most people miss: daily or monthly maximums convert to real hours of care. If your policy pays $200 per day and your local agency is $42 an hour with a 4-hour minimum, your day buys 1 visit of 4 hours and leaves change that you might not capture. Need 6 hours, you're paying the extra out of pocket. For memory care, it's worse. Many policies designed years ago assumed assisted living rates that no longer exist, and facilities may charge add-on fees for higher care levels that your policy doesn't recognize. Let me show you the math so it clicks. Say you've got a $6,000 monthly max, 3% compound. In 10 years, that's about $8,060. If local home care climbs from $30 to $45 an hour over the same period and you need 8 hours a day, you're at roughly $10,800 a month. Your benefit covers about 75% at first, then less as needs rise. Add nights or supervision for dementia and the true cost can jump to $14,000. The rider didn't fail, the cap met reality. Lifetime maximums create a second squeeze. If your pool is $300,000 and you claim it $10,000 a month, that's 30 months on paper. In practice, elimination periods, partial reimbursements, and uncovered services stretch timelines but not dollars. If care escalates to $12,000, the pool drains faster than you projected when you bought the policy. The thing most people miss is that a rich daily max doesn't save you if the lifetime pool is too small relative to realistic durations for dementia, stroke recovery, or frailty. Another blind spot: assuming Medicare fills the gap. It doesn't cover custodial care, help with bathing, dressing, or supervision beyond limited skilled episodes. So when your daily cap runs short and your lifetime pool burns down, there's no Medicare safety net. That's why we stress test now, not in crisis. Here's the shortcut nobody teaches. Convert every benefit into hours. Take your daily or monthly max, divide by your local agency's all-in hourly rate, including holiday premiums and minimums, and that's your real buying power. Do this for home care, assisted living, and memory care. Then run a simple gap chart for year 1, year 5, and year 10 using local inflation, not national averages. You'll see exactly where your policy stops and your wallet starts. Common policy fine print that magnifies the gap. Caps that reset daily, you lose unused amounts. home care per visit minimums that waste benefit dollars, and exclusions for unlicensed caregivers that force you into higher-cost agencies just to qualify. If your policy has a monthly max instead of daily, that's better. You can stack more hours on heavy days without losing unused daily dollars. If it's daily, plan your scheduling to hit the cap efficiently without leaving stranded benefit. Let me give you a concrete stress test you can do today. 1. Pull 3 local quotes. Agency home care hourly with minimums, assisted living base plus care level fees and memory care all in. 2. Project each cost 5 and 10 years forward using the last 5 years local trends. 3. Project your policy forward at its rider rate. 4. Subtract. The difference is your monthly gap. If that number in year 10 makes you queasy, good, you have time to fix it. How do you fix it? You've got levers. Keep the rider if you can sustain premiums, but pair it with a reserve bucket specifically for inflation gaps. If your policy allows, consider increasing the monthly max now rather than later. Small bumps today can be cheaper than trying to replace benefits after health changes. If you're already locked, focus on efficiency. Avoid daily benefit waste by scheduling longer visits, fewer days if you're capped daily, or switch to providers whose minimums align with your cap. Now, lifetime pools. If your diagnosis risk leans toward longer duration conditions, family history of dementia, Parkinson's, plan for a longer but lower intensity spend. That argues for preserving a portion of your pool for later years and building a parallel cash flow source like an annuity bucket to carry the base cost so your policy covers spikes and nights. If your risk leans toward high intensity but shorter duration, post-stroke rehab, cancer-related care, aim your cap and pool at higher daily max for the first 18-24 months. Quick win, call 2 agencies and ask for their current hourly rate, holiday rate, 4-hour minimum policy, and any weekly minimums. Then ask if they can bill tasks by ADL on invoices. Aligning invoices to ADLs maximizes reimbursements and reduces rejected hours that inflate your gap. If you remember nothing else, remember this: riders fight inflation, caps define reality. Translate your policy into hours, price care locally, and build a cash plan for the gap. Do that, and you turn a vague promise into a working budget that won't blindside your retirement. The better method: layered, legally safe protection.